So hello and welcome everyone. In the last lecture, we was discussing about liquidity adjustment facility. Okay, and I have explained you in detail about liquidity adjustment facility, why it was required, how it came in the picture, and the unique thing about the liquidity adjustment facility means whenever there will be the repos. Okay, whenever will be the repo operations, they are of two types. Repo operations are of two types, that is repo rate and other is reverse repo rate. And what is the unique feature of the repos? The unique feature of the repos means here government securities will be traded once the RBI and bank RBI and bank will deal in repo and reverse repo, there will be the complete transfer of government securities for the said period of repo and reverse repo operation. So the complete transfer means what? Whosoever is going to get the government security, they are going to have the right complete right on those government securities for the same term. But at the same time, there is a repurchase obligation. That is why it is known as repo. Repurchase obligation will be there. So government security trading while taking the loan or taking the loan from the bank side or RBI taking the loan. So these are the collateral based facility, right? So loan is always collateralized. Whereas I told you in the operation of what? In the operation of money market operation. Money market operation. Those money market operation is what? That is call borrowings, and for notice borrowings, there is no such kind of a thing of collateral. No collateral is there, but collateral is here, right? So this is why this facility is very popular, right? And once it was introduced, liquidity adjustment facility, lot of things happened over the time. And to make you understand some recent changes in the repos, some recent changes in the, they are not changes, actually more variety of repo, more variety of repo was introduced by the Reserve Bank of India, especially since pandemic hit to the all over the world in the economic system. RBI has used the repo operations more effective manner, and it has introduced new things. So what are the new things in the repos? To make you understand, I'm going to take the RBI circular as an example, and from there you will get the clear cut understanding what I am trying to tell you here. What are the new things under repo, right? So this is the RBI circular, which was used by the Reserve, means issued by the Reserve Bank of India. You can see that it's a Reserve Bank of India circular of 6th February 2020. As I mentioned that this was effectively utilized during the pandemic. So what are these things? So here the first thing, you can see that instruments under LAF framework to manage short-term liquidity or transient liquidity, right? So transient liquidity or short-term liquidity. First, here it is mention of 14-day variable rate, 14-day variable rate repo, reverse repo auction. 14 day variable rate. So duration is fixed. What? 14 days. Interest rate is variable, and it is not kind of, it is going to be auction. Auction will be there, means the bidder who is going to be the highest bidder or lowest bidder is going to be the winner, right? So variable rate reverse repo auction, right? And again they have wrote that what auction amount will be decided by the Reserve Bank of India, and a single auction, either repo or reverse repo, will be conducted on the basis of assessment of liquidity condition by the Reserve Bank of India. So one kind of the repo is what? That is variable rate repo. Variable rate repo means, but duration is fixed here. In the variable rate repo, duration is fixed, that is 14 days duration, but interest rates are going to vary, right? So it is variable rate repo. Another important change, actually this is the important thing you have to understand here, is the variable rate term repo. Variable rate term repo. So when they are saying variable rate term repo, tenure, right? Here you can see that duration is already fixed. They have mentioned that 14 day. But here they are mentioning what? Overnight and up to 13 days. Fine tuning operation. So tenure, it can be changed. So what is the main difference between entry number 1 and entry number 2? Both are repos. Both are repos, but here duration is fixed, right? Interest rate variable. Interest rate is variable. Here in the second, what they are saying, variable rate means interest rate is also going to vary. Interest rate is going to vary, but duration is also going to vary from 1 to 13 day. Duration is also going to vary from 1 to 13 day. So that is why it is known as variable term repo. Variable term repo, because it can be of 1 day, it can be of 2 day, it can be of 3 days. If you want to compare in CRR related operations of call borrowing and notice borrowings. In call borrowing and notice borrowings, 1 to 13th day up to 14 day, right? So 1 to 13 day and 14th day means you can borrow for 1 day, then it is call borrowing, and if you are borrowing for 1 to 13 or up to 14 day, then it is notice borrowing, I told you. But here that is non-collateral, no collateral. But here these are the repo operations. So whether it is variable rate repo, where the duration is fixed for 14 days, or it is variable rate term repo, here the tenure is from 1 to 13 day is there, but here the collaterals are going to be used. Here the collateral is going to be used. Fine. So collateral is going to be used. This is the distinguished feature which I am repeating again. Sorry for the interruption. So this is what I am trying to explain you again and again. What here, what they are going to do here, they are going to use government securities as an what? Collateral, right? The main thing which why I have used this one is not only these two things. Another thing, I'll tell you what is the fixed rate reverse repo. I told you about the what is reverse repo. Fixed rate means what? If you will see in the first and second instrument, interest rate is going to vary and it is going to be auctioned. But fixed rate means what? RBI is going to borrow from banks at the fixed price. If I'll say about statement number 3, statement number 3 is saying that RBI is going to borrow from the banks at the fixed interest rate, right? If I'll say about the first statement, I am going to say that it is repo and reverse repo operation. So I will simplify this. Statement number 1 is how 14 days variable rate repo reverse repo auction means I am simply going to say RBI either going to borrow or RBI is going to lend from or to commercial banks for 14 day. For 14 day, interest rate may be vary under the auction. Interest rate will be vary, but the duration is going to what? Duration is going to be 14 days. For the second, the statement is going to be more versatile. In this statement, what I am going to do, I am going to say is RBI either going to lend or RBI is going to borrow from banks from 1 day up to 13 day, depend upon the situation, and interest rate will also vary day to day basis, right, during the auction. Whereas in the third statement, I am going to say that RBI is going to borrow from the banks on the fixed interest rate, right? Margin standing facility, I am going to explain. Forex swap. What is Forex swap? Actually, we have a chapter of balance of payment. There, Forex swap is generally used for maintaining the value of Indian rupee. Just giving in a small example, what is a swap, how it is work, you can understand from this point. For example, $1 is 80 rupees, right? $1 is 80 rupees, right? Whereas the same time, $1 is equal to, suppose, 2 euros, right? $1 is of, sorry, 1 euro is equal to $2, right? And 1 euro is equal to how much? Just for your understanding, considering it is 90 rupees, right? 90 rupees. So 1 euro is of 90 rupees. 1 euro is of 90 rupees. Okay. Whereas 1 euro is equal to $2, and at the same time $1 is equal to 80 rupees, right? So what it means that, it means that RBI have made an arrangement with French central bank, right? RBI has made an arrangement with the French central bank, and RBI said that, okay, what I will do, I will give you what? I will give you 100 euros, right? I will give you 100 euros, right? This 100 euros you can convert into how much? You can convert into $200, right? And on my behalf, you can pay it to US Fed Reserve. US Federal Reserve. Actually, RBI have to pay. RBI have to pay how much? RBI have to pay $200 to US Fed, right? RBI have to pay $200 to US Fed. So rather than paying it directly to US Fed, RBI went for French central bank and made that arrangement. What? RBI will transfer 100 euro to French central bank, and that is going to be paid by French central bank to US Federal Reserve in terms of $200. When I said this thing, right, so you can clearly see that RBI has paid how much? 100 euros. 100 euros is equal to going to be how much? 100 euros is going to be 9,000 only. As per this calculation, 100 euro is equal to 9,000. Whereas if RBI have to pay directly $200, if RBI have to pay $200 directly, then as per this calculation, how much? RBI have to pay 16,000 rupees. So what RBI have, if RBI is going to pay directly, RBI have to take 16,000 rupees and have to convert in the dollar, right, and pay to Federal Reserve. But RBI did the smart thing. RBI asked the European Central Bank, French Central Bank, I'll pay you the 100 euros, and as per the market, 1 euro is equal to $2. So you can pay US Federal Reserve on my behalf, right? So lot of questions are maybe going to arise in your mind. Lot of questions. First question is, why French Central Bank will do for your behalf? Number one question. What is their benefit? Right. And if it can be happen, why all the payments you are not going to do in this manner? Right. And what this system known as? So what I explained you here, this is Forex Swap. So what RBI is going to do, RBI is going to swap its loan in terms of dollar to euro, right? So you have a loan of dollar, but you are swapping this loan from dollar to euro. So here you can see that clearly, very clearly, French Central Bank is doing a favor for you. Otherwise you have to pay 16,000. Here you are paying just 9,000 rupees. So it is a clear cut favor, right? It's a clear cut favor. So if there is a clear cut favor, means what? It is economics, right? It is economics, and economics is little bit cruel, because here things will happen only on the basis of give and take. Goodwill is there, but maybe that goodwill is in the form of long term benefits rather than looking for the short term benefits. So when this swap operations will happen, that is only on the basis of mutual understanding, number one. Number two, both countries are having kind of very good understanding in terms of their strategic goals. For example, just for a brief, I am discussing with you. You can see that lot of activities are happening in the Indian Ocean region right now. Indian Ocean starts from South China Sea, right? Below from South China Sea, where all the ASEAN countries are there. It starts from there, and it will go to Cape of Good Hope of Africa, right? Or Horn of Africa there. So that entire region comes under the Indian Ocean. But lot of activity from Andaman Nicobar Islands to South China Sea, that is right now hyperactive zone. China is rising, and China rise is going to be countered by US, because they are challenging to the US. Fine. So US is very strong hold in the entire region. Now French also have some territorial positions in this region, but you need some kind of big power cooperation so that you can also be influential, right? So this is one of the main reason why France and India are cooperating at higher level. So this kind of cooperation, understanding, need lot of confidence over each other, right? So once the France is going to favor you, right, or India is going to favor the France, then the understanding is going to be what? At higher level. So sometimes to develop the understanding, sometimes for the mutual cooperation to provide benefit each other. That is why I'm capable of doing this thing. So that's why I'm doing. So these swap operations will happen with two reasons. One is long-term strategic goals, right? Other is mutual benefit even in the short term also, right? Mutual benefits even in the short term also. But that mutual benefit in the short term, I have to explain each and everything related to foreign exchange, which is not possible here because it's a complete chapter. So I'm not going to take this part, just explained you what is Forex swap, how it's work, right? Why it is work, what are the purposes, we will discuss in detail when we'll go to that chapter. Just for your understanding, Forex operations. So RBI do the Forex operations. Sometimes RBI also do the same thing on the behalf of any other central bank, right? So this way, this Forex operations happen. I hope this is clear. Sheetal Rathore, sir, please give me RBI Grade B Phase 1 and Phase 2 strategy. Sheetal, and yesterday we have conducted one session with B Chandrakant Reddy. You can go through that video. In that video, I and he, especially he, has discussed detailed strategy discussion was there. You can go through that video. That video is very helpful for all of you. It is available there. You can go through that video. It is going to definitely help you. Okay, so Forex swap is clear. How Forex swap is work. Primary understanding is clear. How primarily Forex swap works. Clear? Not getting any reply. Okay, fine. So Forex swap is clear. Now another term is used here, standing deposit facility. I'll explain you this thing, but let me complete this part. This part, what is long-term variable repo? Long-term variable repo. And in short, it is known as LTR. So what is LTR? It's, see, long-term repo beyond 14 days. Beyond 14 days, they have not mentioned up to. They have not mentioned up to. From 14 days to what? From 14 days to what? Right? So, going back again to this PDF, here what I told you, there is bank rate, LAF and MSF. These are the three policy rates, right? Bank rate is long term, interest rate minimum 1 year, LAF, repos and reverse repo. And under this, I told you just through that circular of RBI, I mentioned you of 14 days. Another was 1 to 13 days. Same thing for reverse repo also. But now what they did, they also have long term repo. Long term repo, that is from 14 days. From 14 days. So what I want to explain you here is bank rate and LTR. Bank rate in LTR, bank rate is actually for long term lending, right? Long term lending, that is bank rate. But LTR has opened an avenue from where banks can borrow for longer duration also, right? Longer duration also. So this LTR has a direct impact on bank rates, because LTR can start from 14 day and it can be up to how many days, that depend between on RBI. So if RBI is going to say under the LTR, we are going to, LTR means long term repo, we are going for this repo auction for say 364 days. So 364 days. So 364 days means almost 1 year. So whatever the bank rate, right? So bank rate I told you for 1 year. Here under LTR, if RBI is going to offer for 364 days, so banks are definitely going for LTR rather than bank rate, because bank rate is little bit higher than LTR, right? So in that way, there was an continuously many economists and market experts, they are saying that there is a still there is a still gap between bank rate. There is a still gap between bank rate and repo rate. Repo rate is rate what on which RBI lend money to the banks. Fine, for short duration. And bank rate is again a rate where RBI lend money to banks for long term. So what experts were saying that in Indian financial system there is a gap between repo and bank rate. So this LTR long term repo has solved this issue. Solve this issue because it can be as per the need from 14 days to 1 year or even go beyond, right? So that is why even some people feel that now bank rate is redundant. Bank rate is redundant, only LTR is sufficient. No, LTR for time being, it is a kind of stopgap measure between what experts are saying between repo rate and bank rate, right? So it comes under that space, LTR, long term repo. And if it is going to be used for reverse repo, then it is going to be LTRR. So what is LTRR? Long term reverse repo. Fine. So got this understanding? What is long term repo? Here the long term repo, tenure beyond 14 days, long term repo. And if it is going for what? Reverse repo operation, then it is going to be known as LTRR, or if it is going for repo operations, then it is LTR. Right? Is it clear? Please write here so that I can move forward. Okay, good. Now, in this circular of RBI, they have mentioned 10 instruments, right? So first I have explained, second one I have explained, third one, fourth one, fifth one I also explained, except sixth one, seventh, eighth, Forex Swap auction I told you, then again open market operation I also told you. Only one instrument is left, that is standing deposit facility, which I am going to explain. So this is why I use this circular, old circular, but is very informative regarding what? Regarding different type of the instruments used by RBI. And most importantly, most of the people do not find this standing deposit facility in the normal course of action under the monetary policy, right? So what it is, I'm going to explain you right now. So let's move to our main PDF. So we have to understand what is standing deposit facility. You have seen that, or I'm this repeated many times in these operations, government securities are being used as a collateral, right? So this SDF, standing deposit facility, is a specific tool to absorb liquidity. So unlike LAF, which can use for both what? Inject or absorb. So if RBI under LAF will go for repo rate, repo auctions. So RBI is going to inject. If RBI will go for what? Reverse repo, then RBI is trying to do what? Absorb. But when we talk about SDF, this SDF is a specific tool for only absorb the liquidity. it is not going to be used for the purpose of what? It is not going to be used for the purpose of infuse or inject the liquidity, only for absorb the liquidity from the system. And how it is going to be used? From the term, it is very clear: deposit. Means under SDF, banks can deposit liquidity in RBI. Right. Then you can say that, sir, same thing happened here in the reverse repo also. RB borrow the money and banks deposited their money to Reserve Bank. But here government securities will be issued by RBI. If RBI is going for this reverse repo operation, RBI will issue this government securities to bank. However, in SDF, banks can deposit liquidity in RBI and there is no need for RBI to issue government securities against those deposits of banks. Right. So you can see that how RBI has opened another space for himself. Right. Under reverse repo operation, RBI is bound to give this security to government securities to the bank. But if banks are interested, they can deposit their money in RBI under this facility, but they are not going to get any kind of any kind of government securities against this thing, because what RBI found that sometimes there is a need to absorb the liquidity through LAF. There is a need to absorb the liquidity through LAF and specifically through reverse repo. But because of unavailability of government securities, RBI is not able to do this operation. So that is why another alternative is being created, that is SDF, where RBI will offer deposits to banks under SDF without any government security. So now if you will compare RRR and SDF, what are the common things? Common thing is what? Both are for absorption of liquidity. Right? Both are for absorption of liquidity. This is the common factor. What is the striking difference? Under SDF, there is no need to issue government security by RBI while accepting deposits from banks. So you are not giving something which is very important. So it's very simple. If you want to attract banks, so they can go for this rather than this, then you have to offer them high interest rate in comparison to RRR. But it is completely discretion of Reserve Bank of India. If they want, they can go for it. If they don't want, they don't go for it. It is absolutely depend upon whom? Reserve Bank of India, as per the need. If RBI feel that there is a need, number one, there is a need. Okay, cautious. Just give me a second. So the bank rate could be discontinued in the longer run. Acha, next question is, sir, when we expect the notification for RBI Grade B? See, I'll come to the question of Shreya, but Manisha and all of you, always put your efforts on those things which can be under your control. Don't waste your time or your precious effort on those things, even thinking on those things which are not under your control. Right? So, such kind of the questions ki how many vacancies will be there or when tentatively notification will be there, what you just have to do approximately in February, March, if they are publishing their notification, then tentatively they are going to send it at that time only. If they have published in past April, May, June, so whatever the tentatively they are sending, that is going to be this year also, right? Because RBI Grade B exam is most consistent exam. They do consistently, even in all kind of the issues they are doing their work consistently. So my take for you is what, you should focus on the preparation without even thinking about when the notification will come, right? No need to even think about it. You should always keep ready, right? So you should always be ready for the war, right? That can start at any point of time. That can be officially declared by the Reserve Bank of India when they will go for notification. But your preparedness should be like that. What? Your preparedness should be like that. So there is two way of doing the preparation. One is I'm going to do each and everything, and second, when the notification will be out, then I will be go for more practice. So, because in the banking exam, they will not take too much time to conduct the written part. They are not taking too much time in comparison to any other exam. They do not take too much time to conduct the exam. So, it doesn't matter whenever the notification will come. What you have to keep this thing in your mind is the day they are going to out with notification, I'll start doing the revision. I'll start going for more comprehensive practice. So you should be like that ki I must complete all the part of syllabus as soon as possible, right? And the day they are going to declare the notification on from that day, I'll start going to be more focused on revision and practice whatever I have did till then date. So this is the way how you have to go for it. Fine. So don't worry about the notification, the date of the notification. Just keep this thing in mind. Try to complete almost all the syllabus. Have the syllabus copy in your study room or in your mobile phone. Always have that syllabus and one by one underline and try to complete the syllabus. And the day notification is going to be out, focus on revision and practice. Okay. Ram, our team is going to contact you very soon. They'll reply you. So Shreya, so the bank rate could be discontinued in the longer run. No, bank rate is not going to be discontinued in the longer run. They are definitely going to be there. But whatever the thing is that even RBI feel that yes, there is some time gap. There is some time gap between repo rate, right? Repo rate and bank rate. So through long-term repo, RBI is going to fill that gap. But bank rate will definitely be going to be there. Bank rate is not going to be discontinued, right? So it will be there, but maybe that is going to be more effective in upcoming years. Maybe RBI is going to lend that money for longer duration, very long duration. For example, 5 years, 10 years, 20 years, 30 years kind of the duration on the bank rate, and rest of the lending is going to the long-term repos. So yes, in the longer run, more role will be played by long-term repos, fine, but bank rate is not going to be discontinued because it is an important pillar under the monetary policy, especially when we look beyond the 3-4 years, especially for 3-4 years, then it is very important tool. So there is no chance of discontinuing it completely. Thank you, Ram. So I hope you got understanding regarding the differences between triple R and triple R means uh, reverse repo rate and SDF. Is it clear? Okay, good. So one thing just left is marginal standing facility, right? Marginal standing facility, it was introduced in 2016, right? And under this you can borrow for just 1 day. Now again question arises कि already under banking borrowings, interbanking borrowings through call rate and notice rate. Call rate specifically for 1 day borrowings, and it is for up to 14 day. So if already interbanking borrowing, which is a part of money market, is already there, it is already there, then what is a need? What is a need? Just give me a second, huh? Just give me a second. Okay, so sorry for interruption. So I was telling you this marginal standing facility. Marginal standing facility, it was introduced in 2016 and for just 1 day borrowing, and that 1 day borrowing from where? 1 day borrowing from RBI. But Question is, when there is a interbanking borrowing under money market, which I explained in detail, I already explained in detail in last few lectures, means I think 2, 3, 4 lectures back, I have already explained this thing. Interbanking borrowing, and interbanking borrowing, there is a call rate, and where bank from other bank can borrow for 1 day. So what is the need to introduce this marginal standing facility? What is the need to introduce the marginal standing facility? So the argument or reason is what? Sometimes there is high fluctuations or there is a volatility of interest rates. So if the interest rate, for example, call borrowing rate, if call borrowing rate is going to be very high, in that case, what RBI will do, for example, here the interest rate was 4.25%, but it is reaching what? It is reaching to 5.25%. 100 basis point. 1% is equal to 100 basis point. So it is increased to 100 basis point. Now, if RBI want to cool it off, RBI will say that we are going to start marginal standing facility for next 15 days, and under that we are going to lend the money to banks who are interested to borrow under 1 day facility at the interest rate of 4.50%. So once RBI will start lending the money to banks for what? For 4.50%. Definitely this interest rate, which is moved from 4.25 to 5.25 under interbanking borrowing, bank will start going here, and that rate is going to be cool off from 4.25 to 4.50, because same facility is already offered by the Reserve Bank of India under MSF. Right. Similarly, suppose that if the interest borrowing is going to be decreased, here it is going to be decreased, right? So what RBI is going to do to increase it up, to increase the interest rate, RBI first will decrease the interest rate and then gradually increase the interest rate. RBI will also offer the low interest rate. So banks will start moving here, and then RBI will start increasing the interest rate, and here interest rate is also going to increase, because from RBI bank will start jumping in the interbanking borrowing again. So this marginal standing facility is going to basically control money market liquidity. Money market liquidity. Then you can say that, sir, if it is for money market liquidity, why we do study under the monetary policy? And why they have mentioned in the monetary policy? So answer is, India's money market is having transactions of more than 5 lakh crores on daily basis. There is a more than transaction of 5 lakh crores on daily basis. So for that, you can understand the importance of money market, and if any high or low fluctuation will be in the money market, right? Especially in the money market, banks are main constituent. In capital market, in the share market, other industries are constituent, brokers are there, right? So lot of participation. But in the money market, banks, government, RBI, they are main and important players, right? So it is kind of inbound responsibility. So it is a kind of mutual understanding. You can say that some areas where SEBI and RBI do have kind of overlapping of the role. But wherever there is a kind of overlapping, right? There is a kind of overlapping, or both think कि I also have jurisdiction in this case. For example, money market. So in some areas, Reserve Bank of India has jurisdiction. In some areas, SEBI has jurisdiction. So if some area like this X area, RBI is feeling that is my area, SEBI is also feeling that is my area of jurisdiction where I can take the decisions. So it is a kind of untold understanding or unwritten understanding. If such kind of the conflict is there and RBI is claiming that is my area, then automatically SEBI is going to be back off. It is no written agreement, but if something is fall in this category, right, where question mark, it is not clear who is by default having the authority. I'm talking about money market only. I'm talking about money market only, not all the market. So if in the money market where RBI, government, and banks, financial institutions are main player, right? They are main player, and there is a kind of what? There is a kind of question mark who have a power to decide, RBI or SEBI, right? So if RBI is going to make a claim कि we will take the decision in this regard, then automatically SEBI is going to what? SEBI is going to back off himself. Though SEBI can push further, but in general there is a mutual understanding, and rarely SEBI and RBI are in the conflictual lines. So where are they are in the conflictual lines? What are those things? It will come once the market part will be over. There is a separate subtopic, RBI and SEBI regulators, how their powers are important for better functioning of our financial system. So when we will discuss entire financial systems reforms and how it can be make better for Indian economy and all, so that point will come, and under that point we will discuss in detail the conflictual and cooperating area between RBI and SEBI. But as of now, you can keep this thing in your mind. Money market by default it is regulated by Reserve Bank of India, right? Reserve Bank of India rather than SEBI. Okay, is it clear? So, okay, if you have doubt, you can put in the comment. So, what I am explaining you, I am explaining about the marginal standing facility. It is a monetary policy tool for very short term lending by RBI, right? And it is a tool to control the money supply, and that money supply largely focus on what? In money market operations. No, Saurabh, they are same. Government securities, see, when we say that government securities, so they are same. Government securities, they are same. There is no difference. They are the same government securities. So this is why, for example, government is going to present the budget on 1st Feb, right? So government will give an idea. Government will give an idea ki how much we are tentatively going to borrow from the market. So on that basis, all the calculations will be done. On that basis, all the calculations will be done. So they are government securities. They are government securities. Acha, tell me one thing, all of you, please, sir. Acha, okay, no issues. Okay, fine. So I have a question for you. Shares of LIC held by government of India will come under category of Jesus. Yes or no? Answer please. Why only limit towards LIC? All PSUs. All PSUs. their shares will come under the category of Jesus, yes or no. Any share of public sector company held by the government of India can be said as a government security. Answer please. Nobody is answering. Why? What is the confusion? Anyone else who want to answer apart from Saurabh? Don't have knowledge to comment on that. No, I'm not asking to comment. I'm asking a question as a teacher, and I'm asking you as a student. So you can make a guess. No issues. Anyone else who want to answer? No one. Okay. Answer is yes. Answer is yes if condition if hold by government. If they are held by a government, so government can transact them as a government securities. So that can be transacted by the government as a government securities. Right. So government can use that as a government securities, and with the permission of government of India, right, at the permission of government of India and RBI, for certain operations banks can also use, but in the very special circumstances. In very special circumstances banks can also use as a government securities, right? But if it is being held by whom? It is being held by whom? If it is held by the government of India, they will be considered as a government security, because government is a de facto owner of all those companies. If they are privatized, if they are privatized, right? For example, Axis Bank is a private bank, right? Axis Bank is a private bank, but despite being a private bank, government still holds some shares in the Axis Bank of India, right? Earlier it was a UTI bank, right? So still government holds some shares, and those shares held by the government can be put by the government for borrowing purpose, and that will be considered as a government security. Fine. So here government and RBI, right? There was a very famous statement by one political philosopher regarding Parliament, British Parliament. Regarding British Parliament, he made a very kind of statement. He said that British Parliament do have a power to make man a woman and woman to man. British Parliament have this power. So this statement is being used for all over the world's parliament in the democratic countries. Here the parliament in India case is little bit different because Supreme Court have this power to overrule any law made by the parliament, right? Under Keshwanand Bharti case. But for British Parliament, it is said that they have a power to make man a woman and women to men. They can declare by the law. Similarly, in the case of India, Reserve Bank of India also have similar kind of the power in their matters. So it is most powerful institution in India. Most powerful institution in India after government of India. Right. So not exactly have that power to make man and man or to women, women to man, but is also having such kind of the overriding power given to Reserve Bank of India over the years. Fine. So that can be treated as a government securities if it is being issued by government of India. Okay. Now, Viva is very happy. So Hope you have guessed or you know the answer. Okay, so guess worked, huh? Okay, fine. So we have discussed all the parts of monetary policy. That is statutory requirements, and under that I have discussed CRR and SLR, right? Then I have discussed market operations, and under that MSS market stabilization scheme and open market operation. Then I went for what? Then I went for policy rates, and under the policy rate, bank rate, LAF, and MSF discussed, right? And I told you in the beginning it is qualitative and quantitative tools. We have discussed all these things under quantitative tools, qualitative tools. I already told you. Fine. So in this way, the monetary policy discussion is over. One thing is just left is here is monetary policy transmission. RBI, banks, financial institutions, public, right? So public do interact through banks, fine, and banks interact through public. So here there is a liquidity, right? Here this is the liquidity. RBI, so this is the RBI. So RBI have an eye on here, RBI have an eye on here, RBI have an eye on here. So if RBI feels that there is an excess liquidity, RBI will drain it out. RBI feel that public have excess liquidity, then RBI have to drain out that liquidity. If RBI feels that banks have excess liquidity, RBI have to drain it out. So in that way, RBI is overlooking this system. So for that, RBI uses this monetary policy. So if RBI is taking monetary policy decisions which is directly going to impact this, so whatever the RBI is doing here, through here, MSS, open market operation, bank rate, LAF, MSF, all these instruments are for banks and financial institutions, right? So RBI not directly involved with public, though recently RBI has introduced direct retail scheme for the public. They can also be like you and me can also trade with Reserve Bank of India for the government securities, but large transactions happen through banks and financial institutions, right? And then they will go for public. So the intention is what? The RBI's intention is to manage the liquidity in the system, but RBI interacts system through banks and financial institutions. So if you have taken certain decisions, for example, RBI has taken the decision to increase the liquidity, right? And accordingly, it has increased the liquidity for banks and financial institutions. So your responsibility is not over. You have to make sure that this excess liquidity must reach to public. Means if you have decreased the interest rates, If interest rates are decreased by the Reserve Bank of India, then it should be positively impact in the market interest rate, right? It should be positively impact the market interest rate. But there are some issues. There are some issues. And one of the biggest issue is what? One of the biggest issue is informal nature of Indian economy. When we have discussed about L1, L2, L3, L4, then L1, L2, and L3, right? So most of the transactions in India still, most of the transactions, especially at local level, right? They are happening in what? In very informal way. Tax invoices or invoices are not being generated. So this highly informal nature of Indian economy is having a severe impact on monetary policy transmission. So something is transmitted by RBI to banks, but it is not effectively transmitted to public because the entire calculation of RBI's monetary policy is faulty. Why faulty? Because RBI is not able to calculate it correctly. Why? Because the informal things are happening in the economy, right? The street side vendors. So street side vendors, whatever the money they are receiving or what is the impact on them in the because of high inflation or low inflation, it is not being mapped properly because of this informal nature. So that is why when we go for less cash economy, so the less cash economy is more and more effectively going to help what? The effective implementation of monetary policy. So the biggest impact on less cash economy is the transmission of the monetary policy is going to be more effective. Why? All the transactions are going to be recorded in the digital formats, and it is going to help RBI to record and understand the things through using the data and stats, right? So this is why it is very important, and that is why government, RBI through banks push go for what? To go for less cash transactions. So that is why cash transactions are being discouraged by the banks and RBI also. If you will withdraw the cash again and again from the ATM, you have to pay. So the reason is what? One of the reason, the implicit reason is what? Implicit reason bank is stating that we have to deploy the resources and all. But other logic is what? They want to discourage you to withdraw the cash, right? And use more digital and other way of transactions, right? So this is one factor where monetary policy transmission is going to be ineffective. One of the problem for the monetary policy transmission. Second is fiscal policy. Fiscal policy also plays very important role for monetary policy transmission. How fiscal policy? Suppose that government want to, RBI want to increase the money supply. Okay, why you want to increase the money supply? You want to increase the money supply because you want more economic activity. Because when people have more money, they are able to spend more, right? And when they will spend more, there will be more demand in the economy. More demand will more demand will trigger more production, and more production will trigger more employment and more income. So in that way you want to increase the liquidity, right? But under the fiscal policy, government said that we are going to increase the GST rate. We are going to increase the GST rate. So if you are going to increase the GST rates, so these GST rates are effectively going to hamper the production activity and the consumption activity, right? So both are going to feel the heat, the producer community and the consumer community. So you are not helping, your policy action is not helping, right? So whatever the monetary policy decisions are being made by the Reserve Bank of India, if our government through its policy, the policy made by the government in the finance domain is known as fiscal policy. For right now, you can understand in the very simple manner, the policy decisions made by the government in the finance and economy domain, they are known as fiscal policy. And tax also come under that purview. So government has increased the tax rate. right? So government has increased the tax rate, so not helping, you are not helping. But if government also decrease the tax rate, for example, Subramanian Swamy, he's also saying that abolish the income tax, right? Abolish the income tax. So if you are abolishing the income tax, what that means? No tax on the income. So people who are paying the taxes as a form of income tax, either they are going to save or they are going to consume. So that is effectively going to increase the demand, one of the radical way of increasing the demand in the Indian economy, right? So in that way, if RBI want to increase the liquidity and at the same time government has decreased the tax rate, so more smooth transmission of monetary policy, more smooth transmission of monetary policy. But at the same time, if government is going to increase the tax, then what will happen? There is a difficulty in the monetary policy transmission. So when we say the monetary policy transmission, especially in India, lot of external factors also work for smooth transmission. And another factor works is banks functioning, right? So for here RBI uses RB Act 1934 and Banking Regulation Act 1949. So Banking Regulation Act 1949 and RBI Act 1934, these two are effectively used by the Reserve Bank of India to control the functioning of the bank in order to smooth transmission of monetary policy, right? So uh, with this discussion, part of the thing is almost over. This monetary policy transmission will again come, some part will again come when we are going to discuss budget. So how many of you are interested for a special budget session where I am going to discuss all history and how the budget is being formed, all these things in a special session? Okay, minimum 5 people. If minimum 5 people say yes, I'll going to do this thing. One person, one vote only. Raj is coming in with two, so three are in. Okay, still need one. Okay, okay, fine. I got five. Actually, that's just kidding with you. Okay, good, fine. So once the budget is going to be published by the government of India, for you, what I'm going to do is number one, first of all, I'll explain you few interesting facts. Few interesting facts about budgeting in India. For example, just give you an kind of example. There is a name James Wilson. He is a founder of the Standard Bank. He is a founder of Standard Bank. Right now, it is known as SNB Bank because this bank, Standard Bank, was merged in 1960 with Charter Bank. So Standard Charter Bank, right? Standard Charter Bank. So James Wilson is a founder of Standard Charter Bank, and this Standard Charter Bank is an oldest foreign bank in India. It's the oldest foreign bank in India because he established this Standard Bank in this subcontinent, right? Standard Charter. And he was the person who first time presented the budget in 1860, right? So circumstances arises, and in 1860 he has presented the budget, and that budget was presented in town hall at Kolkata, right? Why the before that there was a no provision of budgeting in India, right? And in the same year 1864, in 1864 India has opted for the financial year. India has opted for the financial year. Before that, no proper financial year was in India. From here, you have decided to go for 1st April to 31st March. Then the issue was arise regarding the railway budgeting. Railway budgeting was separated, right? Then again government of India has added the railway budgeting. So lot of facts, then constitutional provision, because government do not present the budget because it is willing to share their expenditure and receipts. Government is bound to present the budget. There is a constitutional responsibility or constitutional foundation on the government to present their budget in the parliament and do the discussions, right? And there is a specific reason to present it on the 1st Feb. Earlier it was presented on the last working day of February. So if you are going to present on the first working day of February and you are presenting last working day of February for say 28th of Feb, so how it is going to make the differences, right? So all these interesting facts I'm also going to discuss. Then the bottom line, what government is going to announce in the budget, right? So what government is going to announce in the budget, but like me, all the platforms are going to flooded with what? Flooded with this a budget. So what I will do first proper analysis. I will do the proper analysis. What is important, what is not important for you. Then I will come with the discussion. Rather than coming first, I am first, I am first. I don't believe I am first. I believe I am the best. Right? So I will come with that. So maybe my presentation of budget means the important features will come with 1 or 2 day delay, but that is going to be the best you can compare with anyone, right? So by this I am going to wind up today's session. Tomorrow I'll start with banking system. Okay, yeah, for tomorrow I'll take the first current affairs session. Tomorrow I will take the current affairs session. Actually I have to take the current affairs session today on Sunday, but unfortunately some reasons compelled me not able to go the entire current affairs in the last kind of thing. So that's why I have decided to first wind it up this today. I'll take the current affairs tomorrow. Okay, all finance related current affairs I will discuss tomorrow. Okay, thank you.